Last week, we got some pretty big moves in the stock market. Friday, prior to last week, we got non-farm payrolls, and they suggested that the economy is slowing somewhat. This is not new news, but on the heels of that, Monday in Japan, which would be Sunday evening, the Bank of Japan surprised and raised interest rates. The differential between Japan and the United States of America means that a lot of individuals are borrowing out of Japan and depositing into the US dollar and running what is called the carry trade. That unraveled in a big way. This rattled the stock market across the board. In the end, though, Thursday we got employment data points, and I've got some charts on that to show you. Those employment data charts show that, yes, the economy is slowing down, but doing so from a massively high level. Given that, we've got, going into this week, we've got inflation, and the inflation numbers should tell us the same story. That inflation is coming under control. The Federal Reserve is going to have some room. However, keep an eye on housing. Going into that, let's jump in. I'll show you some charts. I believe the stock market's going to calm down, probably continue to inch higher a little bit. I don't know that we're going to hit those all-time highs, but eventually this economy will slow down rapidly, and the Federal Reserve is going to be in a big race to lower interest rates, but that's probably about 3, 4, 6, 9 months from now. I'll show you some charts. Here we're looking at US dollar versus Japanese yen. And as you can see, the dollar has fallen over the past couple weeks. And to be honest with you, I'm a little surprised the dollar yen moved higher. So here's what happens. Bank of Japan, let's call their interest rates 0, which is fairly close to reality. United States, you're at 5%. In the FX markets alone, if you merely put on the trade, you get what's called carry if you carry the position over on a daily basis. So if you are short yen, long dollar, you receive the excess interest differential between the Japanese yen and the US dollar. In that case, it's 5% annualized every single day. Given that, what happens next is simple. Bank of Japan raised interest rates. U.S. Federal Reserve is in the process of lowering interest rates, which means that differential is tightening. And what happens with the currency is real simple. The quantitative traders are sitting there measuring what they can borrow and buy and sell in order to gain as much of that carry trade as they can. Well, the carry trade is unraveling if the Bank of Japan is going to be raising interest rates and the Federal Reserve is going to be lowering interest rates. The differential narrows and individuals are getting out of that. This is decoupling or deleveraging from risk. And because of that, there will be ripple effects throughout probably the next 6 months, 2, 3, 4, 6 months period of time as these work their way through the system. Not only did these FX traders put on that position, but they also probably leveraged that position, borrowing those funds, and are investing on the other end. Now they have to deleverage that. This could create volatility. I don't expect a whole lot. I think a lot of the moves have actually already occurred. All right, so that was that. Here's a look at, I think this is the 2-hour bar chart on SPY stock. And as you can see, we were just at all-time highs not long ago, and now all of a sudden we're down considerably. We went from about 560 in SPY stock all the way down to 530-ish, and kind of bouncing around a little bit. I don't know that we're going to see these all-time highs again, because what's happening is, again, sort of a deleveraging, if you will. If the U.S. economy is slowing from its very rapid pace, the stocks, expectations from traders are that revenue gains were moving rapidly, but are now narrowing. Because of that, stocks are going to be revalued, which means moves to the downside. Now, I've said many times that my expectation is October, November, December, all through January, February, March, April, May. We're probably going to see a lot more volatility as we see the economy slowing down more and more. But I don't see a recession. Not yet. We don't have any information on that. Here's a bigger look at sort of the damage, if you will. This is a daily chart going back quite a bit. You could see we're off from the highs, but still very high with SPY stock SPX. Here's a look at the US 10-year Treasury. It's a nice medium point between the 2 and the, say, 30 or long-term rates. Interest rates, I don't expect interest rates, notwithstanding anything we don't know, such as some not exogenous event, I don't expect interest rates to be moving higher based on any material other than, say, the US debt. There's going to be a lot of supply hitting, a lot. If we're running at like 4% unemployment rate, we may go as high as 5%. That 1%, those are taxpayers. All right, we're running at a debt to GDP ratio that's near record high. We've moved off that near record high, but we're still very heavily debt to GDP in an economy that's running full steam. Things need to get under control. I've always said that. I don't run my personal assets like the U.S. government. Otherwise, I'd probably be driving a Lambo. Regardless, I don't see any reason why the interest rates would move higher, much higher, from these levels. We may see a pop above 4, but I don't see 425, 430, 440 anytime soon with the 10, given that I'm still long my TLT stock and we'll hold on to that until it clears at least 110, maybe going into 115, 120, maybe as high as 125. That's a long shot, I think. We'll see how bad things get with the economy. Here are some employment numbers. Initial jobless claims. This sort of saved the stock market on Thursday. All right, we're a little bit higher. But when you look at the bigger picture on initial jobs claims, sure, we're a little bit higher, but in an economy that's still printing a lot of jobs. We just printed, what was it, 110 2 weeks ago on Friday, non-farm payrolls. That's still positive. Here are continuing claims. Climbing a mountain. More like a molehill. This is a bigger look going all the way back to 1990. As you can see, continuing jobless claims are higher, but still relatively low when you look at the bigger picture. Of course, you can see 2020 there. That's COVID. You can see 2008. You can see the recession or the dot-com bust in, what was it, about 2002, 2001, going all the way back to 1990. We had a recession as well. You can see those 4 recessions right there. We are nowhere near those levels, and things may moderate from here. This is where I really kind of do all my analysis. This is personal incomes versus personal expenditures. And I always default to this chart. Income drives expenditures, and what you're looking at is the year-over-year change or rate of growth. We're about 2.5% for income and expenditures. And even though we are seeing less people being added to the employment rolls, we may get down to 0, in fact. We probably won't see expenditure growth rates below 0, which would drive GDP. This is kind of the big picture look. Gross domestic product versus personal expenditures. You could see the tight correlation. These are year-over-year growth rates for both. And as you can see, the blue being personal expenditures, it's moving back up above 2.5%. We will see GDP growth rates probably moderate down to, say, 3/4, 3/2, maybe 4%, but that's still positive. So when I see these calls for recession, I think, where's this coming from? Slower employment growth does not mean recession. So the stock market may very well get confident and start buying again. As long as incomes and expenditures remain above 0, which they're about, 2.5% now, on an annualized growth rate, GDP will still continue to be positive. Now, there's other contributors to GDP, obviously, and GDP is what's within a country. You've got government and you've got business expenditures and agriculture. Business expenditures follow personal expenditures. That's the demand cycle. That's where everything begins. So, although we saw a pretty big drop last week, a lot of it due to exogenous events, which of course was the volatility because of deleveraging from the FX markets, I don't see a lot of spillover into the stock market at this point. Wednesday we get CPI data, and it's probably going to come in giving the market confidence that inflation is lowering at a rate fast enough that the Federal Reserve will be able to lower interest rates. But the economy itself, growth rate, is moderating. We're not going to see these accelerated GDP growth rates. That will translate into lower price to earnings variables with stocks. You'll still see some stocks being pushed on the margin for higher yielding, but I think those days are probably going to be gone with, and from here we'll see more value investing kind of approaches to some of these stocks. We'll see how that plays out, but I'm looking November, December, January, February, March, April, May. Things could change. If the Federal Reserve waited too long to lower interest rates, we'll start to see those effects then. That's when we could see information that says this economy is coming to a screeching halt. But we're a long ways from that. Make sure to hit that like and follow button. I did a write-up on my Substack channel down below. We'll see you in the next video.